Good afternoon, Kelly and Herschel.
Good afternoon, Kelly.
Hey, and hey to everybody that is watching us. This is MoneyWise Wednesday, the adult session for the debt management topic. So hopefully you guys were able to join us at the 10 o'clock with your kiddos. We talked about the same topic for them. Herschel introduced the concept of debt to them. So we followed along the story of Jen. So today we're just going to have a little bit more adult discussion about debt management, and we're going to dive right in for the sake of time. I don't want to keep you guys too late. I know some of you are going to be watching on your lunch break. Some of you might be listening as you're going from point A to point B. And some of you might be at home squeezing this in, right, between tasks and homework assignments for kids. So let's just jump right in on the topic of debt management. Herschel, can you just share with everyone why did we pick this topic for this week?
Certainly, Kelly. We're facing a time of uncertainty right now. If you joined us last week, you know that we challenged you to start a budget. With all the uncertainty that we're facing, a budget is the first way to control your finances during this time. Managing your debt is a big part of your budget. We also told you about our Skip a Pay program and that we are rolling back most Envision loan payments for 60 days to June. We aim to help you free up that extra income right now that you may need to supplement any income that may be lost or extra expenses that may arise. More importantly, the timeliness. It's times like these when our eyes are open to reality. Sometimes we wish we could turn back the clock a bit and use some of the best practices that we've learned along the way with our money and our finances. We just never got started on that, right? I think it's a little daunting to think about where to begin managing debt, especially now. So today we want to talk to you about all the good debt management tools so that you can say that you didn't, so you can't say that you didn't know, regardless of when you're ready to start.
Yeah, thank you. It's true. I can think of all the things that I learned up to this point in my life about good money management that I'm like, I'll start that later, right? Or I'll start that when I'm 30, or I'll start that when I'm 40. And you find yourself, there, and you're like, why didn't I do what they told me to do 10 years ago? Or this is where I'd be had I done all those things. Yeah. So you're absolutely right. But there's no better time than now. I know right now people think, but there's crisis, there's uncertainty, there's all of this. Like, how in the world could I ever do that? And so whether you're someone who can start today and start managing your debt today, or whether you want to hold your breath and wait for all this to be over before you do it, it doesn't matter. We're going to share it with you today. You pick what's best for you. You pick what will work for you. But I'm certain that you'll be able to find a couple of little tools that you could go ahead and start doing right now, even in the face of all this uncertainty, right? And timeliness. So Kelly, Mark, I believe that you have some statistics for us. You found some statistics that are going to help us kind of get an idea of if our debt is high, is it low compared to maybe some averages. What did you find out there?
Absolutely, Kelly. I looked up reports from the census, and what I found was specifically for our area in North Florida, I found that the average income per year is $57,300. And what that equates to is around $4,800 a month per household. So we take that into consideration, then the average debt for those same people is $49,000. And that doesn't include a mortgage. So that roughly equates to around $600 a month in regular payments. And then when you add in the mortgage, the average mortgage for our area is $230,000. And that equates to around a payment of $1,300 to $1,600. And hopefully you can explain that to them a little bit more on how on the differences. But basically what that means is that we pay out of that $57,300 a year, $2,200 a month goes towards our bills. So that's the average. So there's people that pay more than that, and there's people that pay less than that. That's just the average for our area.
Sure. Yeah, that's good information to know. I think I was looking at the graph too that you had emailed me, and it, for those of you that are at home, just to kind of give you an idea of the types of debt that are kind of contributing to that number. First of all, there's about $14 trillion in debt in the US. And I don't mean like the government's debt. We're talking consumers, right? So me, you, Herschel, we are all contributing, right, to these numbers. Mortgages, of course, is going to be the highest percentile. A huge majority of it is going to be mortgages. The next highest area is going to be student loan debt. And what's interesting is in 2003, student loan debt was probably only the third or fourth highest. And it's grown substantially. But also student loan debt has also become one of the highest areas of loan defaults too. So you have more students qualifying or getting student loans, but you also have more students that are defaulting on those loans and not being able to pay them back. So that's a whole nother lesson. That's a whole nother class. That's a whole nother discussion. But it's a scary increase, and it's increasing, fast. I think it was $5,000 per second, I believe, is the growth. And don't quote me on that. I just remember going to a class with our very own Tony Neff, who to a college students just this last semester, that we were able to show up somewhere and be around people right face to face, and the numbers he provided was staggering. But anyways, the next highest area is going to be auto loans. Auto loans and credit cards were actually hand in hand back in 2008 and 2009. Since the market kind of got healthier after the 2008, 2009, 2010 recession, we noticed that credit card usage kind of stayed about the same, but auto loans have surpassed it. Auto loans are growing. And that's, I think, because a lot of people were hanging on to their old vehicles, right? And they're like, okay, it's my turn now. I'm going to get that car I wanted, right? Or my credit is better now, so I can afford, my income is, picks back up. So mortgages would be the highest. And then the second highest is student loans. The third highest is auto loans. The next one would be credit cards. And then home equities and other debt are the next two. So other miscellaneous type loan types. So that kind of gives you an idea of the priority, I guess you could say, or the growth of some of those. Those statistics kind of really help put things into perspective, I think. Okay, we're going to jump on over to our MoneyWise suite. If you're not really sure where MoneyWise is, you'll find it on our website. You can also go back to look at our videos that we've posted on social media, as well as our website of our past MoneyWise Wednesdays. We're going to jump right in for the sake of time, though. And if you want to catch up with the budgeting one or the identity protection one from weeks before, find those videos, and then you can follow along with us. All right, I'm going to jump on over here to debt management, and we're just going to go through this one so you can see what this playlist looks like at home. All right. So another statistic for you shows you that there's approximately 80% of us that are in debt. That's not really a shocking number. I think we all, American adults, that's probably pretty accurate. I mean, if you think about people that you know and the ways that they spend money and that kind of stuff. So whether it's from the types of loans that we all talked about just a little bit ago, or the types of debt or credit that you have available to you, we're going to talk a little bit more about this. Now, Herschel mentioned something earlier about not all debt is bad debt. He said good debt and bad debt. When I was growing up, debt wasn't good to me in my mind. So I never thought debt could be good. But that's a misconception, I think, right? One thing that might really surprise us is there are certain types of loans that can really help boost our credit, right? It can really help us earn more if it's a positive investment, that sort of thing. So let's talk about what the difference between good debt and bad debt is. Good debt, certain investments like buying a home, getting an education may require us to take out a loan in order to be able to afford that, of course. They're considered good debt because they can help increase our net worth, right? They can appreciate. So they're going to rise, their value is going to rise over time, okay? Bad debt is usually referring to loans that are taken out that depreciate over time. Maybe there's no collateral that has a value tied to it, right? So it's considered a bad debt because it tends to lose its value over time. So think of a credit card as a great example of something that could be bad debt if you don't use it correctly, right? So, or if you were to consolidate debt into one and then still go spend more money on those credit cards that you just consolidated, right? Herschel sees a lot of people that he counts, as our financial advisor, he sees a lot of that, and that's certainly a great example of a bad debt. All right, so how much is too much debt? So we're going to use some of the numbers that Kelly gave us as these statistics averages for where we live in the region of the country and in the state of Florida here, to just do some calculations. Now, most of you probably know what debt to income is, but and it is a pretty simple calculation. You simply take, the ratio of how much do you make and how much do you owe. So Kelly, let's see. You gave us the number of the average debt here. I guess we'll include our mortgage. You said it's about $2,800. Was that right?
$2,200.
2,200. All right. So we'll just plug in 2,200. Again, remember this is an average, right? We want you to come to this playlist on your own time and plug in your own numbers so you can see exactly how much your DTI is, and all those other scenarios you're going to see here in the future. So go ahead after today, go ahead and gather all of your statements. If they're digital, if you get paper mail, if you have an Excel spreadsheet that you keep up with, however you do it, and go ahead and find out what is my minimum monthly payment on all of these, what is my interest rate on all of these, what are my balances. And that way, that's the first step to really getting yourself in management mode, right? It's just, you got to know where you are on all of those areas. And then we said the average income is $4,800 gross, right? So yes. Gross before taxes, right? Your debt to income is based on your gross amount, not your net amount. So let's calculate what the average is here. And it looks like our average estimated DTI is 45.83. So 45% of our income is going towards debt. Now that is including our mortgage here. All right, so here is a good chart that tells you what is considered kind of healthy or not, right? If we are at, what did I say we were at, 45%? Okay, so 30% or greater is risky. Most of us might think, well, hey, I still have half. How could I be risky? Okay, think about it, guys. Well, tell me, Herschel, what are some risky life events that might cause this to be putting it at risk?
Elevated. So whenever you start talking about that big number of 45, typically the risk tier that a lot of lending organizations like to be within is 35% and below. Whenever you start exceeding that 35%, we start looking at the red light because you're considered almost close to where you're utilizing all of your income to maintain your everything. This is just what's recorded on your credit bureau, Kelly. Let's make sure we make them aware of that. This is the debt that's on your credit bureau. This isn't the debt for your utilities that you have monthly.
Right.
This is the debt that you send over to mom every month for her housing allowance because you're helping supplement her income for $200. This isn't the debt that you pay for your lawn care or your pool maintenance or anything of the such. This is recorded debt. So keep in mind that number is going to typically be a lot higher.
Yeah, Kelly, can you think of life circumstances that are risky, like that could potentially cause a loss of income?
Sure. A loss of a job, an illness, a family member's illness, what we're experiencing right now. You could have your job, but if you have to help out a family member with kids or grandkids or with each other, I mean, there's things that happen every day that are outside of our, that we can't control that affect this situation. I mean, if your money is so tight that a little thing is going to set it off, if something big happens, like let's say you get into a car accident and you don't have gap insurance on your car, then that's a couple $1,000s potentially that you're going to have to come up with. And if you don't have that, it just sets everything off. And it can just be something really minor that happens that sets the whole thing off when you're this close on your debt to income ratio.
Right. No, excellent points. Yep. All right. So how then should we consider how much we should pay back each month? This is a really a good common method. Again, one, one method doesn't work for everybody. Okay, we're not trying to fit you guys into a box. We are trying to teach you that there are other ideas about managing your money. Hopefully we're going to enlighten you and share with you an idea that may work for you. I manage my money a tad different than my parents did, right? And I learned from my parents, right? I have influence from maybe some successful things or not so successful things my friends have experienced, right? But I got to do what works for me. My husband and I have to talk about what works for our household. So that's really what I'm saying here. But a common method to start, if you're not already managing money, which is an easy guideline for you, is to use the 50-30-20 rule, okay? And this recommends that 50% of your income goes to your needs, your essential needs, 30% goes to wants, and 20% goes to savings or paying off debt. Some of you guys, 50% of your income is going to paying off debts, right? Maybe even more than that. Some of you are spending 70% of your income just on your housing, whether it's your rent or your mortgage. So it's okay if you are, you got to adjust the other parts of the formula here then. If you're going to spend 50% on needs, then you adjust the other two to be either, to calculate to be 50% on the other things as well. Does that make sense? So let's use our calculator here to figure out what our 50-30-20 rule is based on the average that we're using here as our for practice. So if I am estimating that I am bringing in 48 per month. Now I'm just going to stick with the gross number here just because everyone's net is going to vary. But I'm just going to stick with the 4,800 gross for now for the sake of simplicity. It's going to tell me 50% of my needs then would be $2,400 a month. Okay, so here's examples of needs: housing, groceries, utilities, transportation. Okay, and for some people, they might put clothing in there because clothing is an essential need for our children. It doesn't mean, oh, I get to go spend money on, the latest, online delivery clothing service or whatever, So anyways, use your good judgment. 30% on wants. So that gives us about $1,400 allowance there for wants. Wants are things for your personal desire. We talked about this in the budgeting lesson. Entertainment, right? Which not a whole lot of us are doing that right now. So we should be able to save in this area. We're getting creative with our entertainment at home. That doesn't cost a whole lot of money. But in this case, additional clothing, right? Hobbies, eating out, gym memberships, that sort of thing. 20% for savings and debts is $960 of this example. I know people who have a whole lot more than $960 in just debt, and they're not putting anything away in savings. Okay, I know it's even a struggle for me sometimes when we want to go on a trip or something. You have to decide, where's that money going to come from. So you should always at least make the minimum payments, obviously, on your debts. But if you have additional money to spend, then in any of these categories, but certainly in the savings and debt category, if you have any extra money to spend, you want to aggressively pay debt down and add it to your savings account. All right, this is something I wanted to share with you right here. This is super important. That's why there's a star by it. A 43% debt to income ratio is the highest that you can have in most cases and still get qualified for a mortgage. So it doesn't mean that, hey, if I'm 43 or less debt to income ratio, then I'm guaranteed to get a mortgage. That's not necessarily what that means, but it shows that you're less risky to a lender. It shows that in the event of an emergency situation, right, or in the event of some of the examples like Kelly gave, job loss or unexpected expenses, you will most likely be able to financially survive a life event like that, right? Because your income is not tied up in high debt, okay, or high interest debt. And it shows that you're most likely not living off of credit cards and revolving loan types. Does that make sense? So let's move on. What strategies can I use to pay off debt? There's two strategies that are commonly used to pay off debt: the avalanche method and the snowball method. Our kiddos learned about the same exact methods at the 10 o'clock class today. So this is something for you guys to be able to talk about as a family together. And we challenged kiddos to talk to you guys about what you do in your family, because again, what works for one doesn't necessarily work for all, but it's really great to expose our kids to the different methods. So Kelly, tell us a little bit, just real quick, what's the avalanche method?
So the avalanche method is when you take your bills and you organize them by highest interest rate to lowest interest rate. And you pay off the one with the highest interest rate first. So you're making the minimum payments on all of your debt, and you're going to take the leftover money, the money that you've set aside to pay on your bills, and you're going to put that towards the highest interest rate first. And that's a little bit harder than the other one that somebody else will explain, but it gets rid of the highest interest rate means you're paying more money back to that lender than you are to the other ones.
Really good. Herschel, tell us what the snowball method is.
Sure. So the snowball method is a strategy that focuses on your higher payment on debt with the lowest balance debt first while paying the minimum on the rest of your debts.
Very good. Yep. So 2 ways to organize. So when you are getting a list of all of your debts together, right? And you're listing creditor A, creditor B, creditor C, right? You're going to list what is my minimum payment on each, what is my interest rate, and what is my balance. This will help you determine at least organization, and then you can decide which method you want. Kelly, which method tends to have a faster, like, first result? Like, you kind of get a win sooner.
The snowball method, because you're paying off a debt faster than you are with the other one. Because the interest rate, the ones with the higher interest rate tend to have a higher balance, like a credit card or something like that. So when you're doing the avalanche method, it takes a little bit longer to see that reward. And the snowball method is definitely my choice because I like to see reward.
Yeah, so a lot of folks really like to have a win. It's like I can see progress happening, right? I don't have to wait as long. And it's certainly for those who, I don't want to say are impatient, but are motivated, right, by checking things off and checking off the list. The snowball method certainly works. But if you're really more interest-minded, right, and you just want more money in your pocket over the long run, the avalanche method may be best for you. I personally like the avalanche method. My husband likes the snowball method. So you can imagine our budget conversation in our house can sometimes be like, but honestly, it's almost a toss, and really, they're both a win for us. So we just compromise and we talk about which one we want to do. There have been some times where we've taken a tackle at it through the avalanche method, and then there's been sometimes we take the snowball method. So it's important, though, that you listen to each other and that you try to get a win for your spouse too, or your significant other, whomever you're sharing in some of your debt with and some of your income with. So, all right, let's move on. So using this example down here, let's test out our knowledge of the 2 methods, okay? So here we have an example of 3 different debts. We've got a credit card, a store card, and a personal loan. You'll see the interest rates for each and the balance for each. So using the avalanche method, which debt would you pay off first, Kelly?
The major credit card.
Obviously, the major credit card. That's right. Okay. So again, it's with the avalanche method recommends that you pay off the debt with the highest interest rate first. All right. The next one, Herschel, I'll let you answer this one. Using the snowball method, which debt would I pay off first using the snowball method?
You would pay off the store credit card, the one with the smaller balance, because you get immediate results.
That's right. So then what we would do is we would take, once we pay off this one, right, whatever we have left over. So let's say our minimum payment on this one was $25 a month, $30 a month. We would, once it's paid off, we would then roll the $30 over to the next balance, which in this case is the personal loan. So we would pay our personal loan minimum payment, and then we would add that $25 or $30 minimum payment we were paying on the store card to it to help it pay off faster. That makes sense? So that's hence why we call it the snowball. All right. We're just going to skip ahead here. We're almost done. Couple of key points here for you to help you get an overall understanding of your debt. Just a few quick, easy steps. Understand your debt. Be aware of the different types of debt that you have, as well as the interest rates for those debts. Certainly plan to at least make the minimum payment on every debt. Kelly, I'm going to pause right here for just a minute because your background and your expertise really could help members right now. What advice could you give members who are maybe in a position where they feel like soon they may not be able to even make that minimum payment? What advice could you give them and next steps could you give them in order to help them out?
I would tell them to call your creditors. Call your credit union, see if we can do a consolidation loan to help you out. Call your creditors and let them know that you're experiencing difficulty, because the hardest thing to do is to fix it once it happens. If you contact us, we can help. That's what we're here for. If you don't contact us and we don't know what's going on, we can't fix it. And then once you do, once that communication is finally made, a lot of times your credit's already been majorly damaged, and it's an uphill struggle. You're climbing that mountain back to get out of the debt, where if you take the time and call us and know that we're not judgmental, that's what we're there for. The credit union has us there to help you out. So give us a call, let us know what's going on, and let us try and help you before it gets too bad.
Yeah. The worst thing you can do is ignore your credit union, ignore your creditor when they're calling you, right? We're real people, right? Kelly's a real person. The department she comes from with all this knowledge is real humans who sympathize and care. And as a credit union, our job is to help our members. So don't be afraid to pick up the phone and call us and let us know when things, are looking scary for you, really, honestly. But we're hoping that skip it pay as well will really help you in the next 60 days, because we've already pushed your April payments to June. So hopefully this will help you get a head start on some savings and maybe come up with a plan. Number 2, be strategic. Go ahead and think about and make a decision on which one of those methods you like, okay? And then figure out if you can make minimum payments, even if it's just $10 a month extra, whatever little bit that you can do. Especially if we're not maybe eating out as much, or maybe we're saving on gas money because we're not driving everywhere. Spend that extra money, put it somewhere else. Like, create a budget to put it towards your debt to help you pay it off faster, or put it in savings, right? Because you're not sure if you're going to need it, right? But at least it's drawing some interest in the savings account. And then this is, again, number 3, don't forget savings. There are other emergencies that we think of outside of, the things that might be going on during coronavirus, but health issues, co-pays, those sort of things that Kelly mentioned earlier. And then ask for help. Be honest with yourself. Recognize the signs that you may need help from a credit counselor. If you do, you can reach out to us. Herschel is a certified counselor here for the credit union. I'm not going to give you his phone number. You might be blowing him up. But you can certainly, you can email us at community@envisioncu.com if you would like to find out more information about that. We can move to, certainly helping you in a one-on-one. All right, so next steps. Review and reflect your debts, right? Create that budget that we talked about last week. Last week's video is a little bit long, but I promise you it's worth it. So if you have some time to set aside, go watch the budget video from last week so that you can figure out how to create a budget based on your needs, right? And then, of course, finding some support by reaching out to us if you need. I'm going to jump over real quick to something else that I wanted to share with you all that Herschel's going to talk about. Herschel, I'm going to let you just start talking. And there's another creative way. We talked about consolidation, right? And then I don't know if anyone mentioned the word refinance yet, but that is another common way that people can get out of a debt pretty quickly. So Herschel, I'm going to let you address that.
Yeah, absolutely. Thank you, Kelly. So the refinance opportunity helps you really truly suppress the interest rate that you may have been provided at the time of your auto purchase, right? So given the opportunity, we would encourage you to reach out to our lenders through our remote channel, speak with them about refinance opportunities. This is the chance for you to take that interest rate and that high payment and put it into a position to where you're empowered. Now you're back in control, not the dealer lot, not the financial institution that may have provided you that higher interest rate. It's you. This is your time. This is now. This is what the credit union is doing for you. So again, look at some of the needs prior to you reaching out to our lending team, but start collecting some of these documents so we can make the process so seamless and so quick for you that you can just immediately start seeing some of the savings, and we can utilize those funds to start creating those emergency accounts that we talked about, helping you pay down additional debt so that you can be better managed within your budget. These are just some of the resources that we're offering you, but more so some of the different opportunities for you to save. So we're here for you. We're in the business of people helping people, and this is just another step that we're taking to make sure that you can save.
Yeah, exactly. So, refinancing a higher interest loan that you might have or auto loan that you might have is a great way. And I believe, just between us, I believe there's something coming soon that might be a special promotion for some people. We don't have any details on it yet, but shh, you heard it here first, right? But I believe there may be something coming down the pike soon to help folks out that aren't already auto loan members with us, right? That we can pair up with that whole skip a pay for existing members to help free up some extra income. So these easy steps, again, just having the stuff ready so there's not a lot of back and forth with your loan expert, but you can do all this online. You can apply online, you can digitally send copies of everything online, and I've seen people get refinances done in a day. It's like same day information. So that other one, that 10-day payoff with the daily per diem is really important. Lenders are gonna have to have that because they got to know how much the check is going to be written for, right, to be paid off. So anyways, that's it in a nutshell. Thank you all very much. Oh, there is one more thing I want to share with you, actually. I'm going to jump back over to our website because I want to show you all where to find our rates. You might be curious to find out what our rates are. So if you go to our website, envisioncu.com, and right up here in the top right, if you just type in rates and do a search, right here on top where this link is, it'll send you right to our rates page. So it'll show you what our loan rates are. And you'll see they were just updated yesterday, and it shows you what your rates are, what an average monthly payment would be with that rate. Tells you what loan types might qualify over here, what your term might be, okay? Again, remember your payment is based on what your rate is, right? And your balance, of course, and your term. Lifestyle loans, these are types of loans that may or may not have collateral tied to them. Okay, just some other examples. A lot of folks are asking about revolving type trade lines, like a HELOC, things like that, that you could draw from. Investment rates as well are right here. So what our return interest rates are on savings accounts and special savings accounts and things like that. So I wanted to show you where that was, just in case you wanted to go calculate a couple of scenarios. And there are a lot of cool calculators out there on the web. I like using calculators from NerdWallet. Be careful of all the advertisements you see. I'm going to go ahead and put a disclaimer out there. So be careful not to click on all of those things, but just go. Bankrate has really good calculators where you can use amortization calculators. So you could say, if I put $20 extra a month on this, how fast could I pay it off? We even have calculators built into our own website, guys. So you can play with all of those, and then eventually, like, if you wanted to export the Excels, you could, and then play around with it and see how fast could I pay off this debt, or should I do avalanche? Like, how much money would I save doing avalanche versus snowball, and vice versa, so that you could decide which one you want to do. Sometimes people want to see the actual hard numbers, So, okay, so thanks for joining us for debt management. Wanted to remind you guys that we're doing a gift card giveaway for every single MoneyWise Wednesday session that we do. So make sure you comment here in the video, like it, share it, all the above. You're entered to win. And we draw a winner every Friday. So we'll be drawing this session's winner on Friday. We'll make the announcement next week. Congratulations to last week's winners. Want to do a quick shout out to Fannie Miller and Sharon Taylor. They both won a $25 gift card, which is on the way in the mail to them. And also, just a reminder, if you haven't watched our other videos, that we give a $100 gift card away every month for the playlist completions. So if you go onto the MoneyWise website, complete a playlist, you're entered to win the $100 one that we do a drawing for every month. So we've already given away 3 this year. So the more playlists you complete, the more chances you have to win. So be sure to go on out there. All right, so I know we had a heavy discussion today, a lot of information, but it was really good information. I hope information that you'll put to work, and certainly a topic that you and your families can talk about around the table. I'm gonna make my 12-year-old watch it, and we're gonna talk about it. So I don't know about you guys, if you're going to have your kids or grandkids or anybody look at them, but certainly share it. Any final thoughts, Kelly or Herschel?
Go ahead, Herschel.
I'd just like to say that it has been an incredible experience navigating through this COVID-19, right? And we're on this journey with you all. As Kelly mentioned prior to, this isn't to tell you what to do. It's how you're going to respond to the information that we're sharing to prove that it's successful for you. Make sure you're checking back in with us, letting us know if you're exercising and utilizing some of the tools and resources that we're providing. But more importantly, let us know what more information we can bring to you. I look forward to seeing you back here next Wednesday, guys. Unsure what the topic may be at that time, but we're excited to bring it to you, whatever it may be. Tune in with us.
And I would just like to say that just remember that there's no right way or wrong way. Just do it. Whatever works for you is the right way. And I look forward to seeing you too. Yep.
Yeah, good advice from both of you. All right, guys, that wraps it up for this session of MoneyWise Wednesday. Week 3 down. We'll see you guys next week for week 4. Bye.
Bye.